What did you think of Howard Marks' comments? I know you two are also looking for cracks in the Mag 7.
Good morning, Frank. Yeah, I think that the really important thing for us from here is selectivity. So if you're looking at the Magnificent Seven, perhaps what has performed, perhaps very well over the past year, 2 years, may not be the best performers going forward. We've already seen cracks in a number of names such as Apple and Tesla, and I think that one can just perhaps find better return expectations from here if you look for selectivity outside of the Magnificent Seven, if you focus on valuations and durability of earnings growth.
So as you say that, by the way, Howard Marks was responding to a question I asked him about a stat that we showed on the show yesterday, that the Mag 7 are forecast to see 40% year-over-year earnings growth, while the rest of the S&P 493 is expected to see a 3% decline. So as you say that, how are you not deeply into the Magnificent Seven with that kind of earnings growth expected and the rest of the market seeing a decline?
Well, we do hold Microsoft and Alphabet. We've been very good sort of long-term beneficiaries of the growth in those companies. If one looks outside of the Magnificent Seven, it doesn't have to be a Magnificent Seven stock to have very good earnings growth from here. I think that might be very biased towards NVIDIA, perhaps, that has shown exceptional earnings growth over the past year. But if you have a look, then, like I said before, at the sort of Teslas and Apples, for example, maybe you're not seeing those same levels. So I think that if you just have a chance to look outside of those seven, there are some great opportunities in companies that aren't getting the headlines, haven't been dominating the market, to buy into them at more reasonable valuations and still get very good earnings growth.
Speaking of, you actually talked to us in your notes about United Healthcare. I'm looking at the charts, though. Month to date, it's down more than 1.5%. The health sector, actually, one of the laggards, down more than 4.5%. But you say this is a valuation play. Just explain this to me with this kind of stock decline. UNH is trading at about 18 times forward earnings, the S&P at about 20.5 times forward earnings. Is there enough of a valuation discount in your mind to accept this kind of a stock decline from a company like this?
So it's a great question, Frank. And actually, United Health Group is a leading managed care organization in the US, and it's trading at its largest discount to the S&P 500 in almost a decade. It looks about 7% free cash yield. And this is a company that's forecast to grow its earnings between 14 to 16% going forward. And it's shown actually 17% compound earnings growth over the past decade, which is far, far in excess of your average company. And so if you think about the scale, the barriers to entry, and then also the valuation that you're getting for buying this name, simply because it's out of favor at the moment, there's a bit of political noise and headline risk going on there. But that discount to the S&P 500 combined with the valuation and the earnings potential of this company, and indeed it's done exceptionally well long term, we think is providing a very good entry point into this name.